June 28, 2017. Hambantota, Sri Lanka. Heavy monsoon clouds drape over the concrete docks. Inside a cluttered port office near the Indian Ocean, Sri Lankan finance and trade officials whisper nervously. Outside, cargo cranes groan and flicker in the downpour as empty container ships drift on anchor. A trader checks the Colombo Stock Exchange ticker on his phone. The rupee slides lower after news of rising debt repayments. The air smells of saltwater and diesel. The sound of distant thunder mixes with the hum of air conditioning and urgent voices on cell phones. At stake is nothing less than the future of this nation's economy and its place in global trade. Across the world, the ports are the new battleground. Massive shipping terminals stretch into the horizon, stacked high with colorful container boxes, giant quay cranes tirelessly loading and unloading goods day and night. In these industrial labyrinths, China's influence is unmistakable. Analysts note that China now dominates maritime trade in terms of volume and construction and ownership of ports around the world. GlobalMaritimeHub.com. In places like Piraeus, Greece, Colombo, Sri Lanka, or Djibouti, Chinese firms operate vast terminals once run by local companies. Each port is a node in what commentators have begun to call China's necklace of ports, a global web of maritime infrastructure projects funded by Beijing's Belt and Road Loan. To the untrained eye, a dock is just stacked containers and idle cranes, but behind the scenes, powerful figures negotiate deals worthy of high drama. In Beijing's corridors of power, state-owned giants like COSCO, China Merchants Port, and Shanghai International Port, SIPG, are quietly buying stakes or long-term leases in dozens of ports. A report from 2024 found Chinese investors involved in 129 port projects worldwide. Reuters.com. The prize isn't territory or troop, but the flow of oil, machinery, medicine, the lifeblood of modern economies. In New York or London, a financial analyst might track stock indices or bond yield. Here, on the weather-beaten docks of Hambantota, the economy's pulse is measured in container throughput and shipping fees. Yet the human stakes are palpable. Dock workers worry about jobs under new Chinese management. Government officials grip pens over long-term contracts, and neighbors whisper about forgotten loan payments. The fundamental question looms large even as Colombo's officials scramble. Why would China spend billions on ports and never send a single soldier to them? In the coming sections, we will trace this maritime saga from the quiet Sri Lankan waterfront to the bustling port of Piraeus, uncovering the secret tactic behind China's bold strategy. For now, one thing is clear: global power in the 21st century no longer always wears a uniform. Sometimes it sails in on a container ship. The stormy docks of Hambantota, we step back to see the wider picture. The southern coast of Sri Lanka, once promised to be a booming trade hub, instead became a symbol of excessive ambition. In 2007, Sri Lanka's government broke ground on a deepwater port at Hambantota, financing it with a series of Chinese loans at commercial terms. By 2010, the first berths opened, and cabinet ministers cheered. The port would relieve congestion at Colombo and anchor the southern economy. The Chinese-built facility even attracted visiting naval vessels from the US and India. But the reality turned grim. International shipping volumes proved much lower than projected, and the port hemorrhaged money. Interest on the Chinese loan, $1.3 billion in total, started coming due. ChathamHouse.org. Reuters.com. By 2016, Sri Lanka's finance minister Ravi Karunanayak announced that nearly $216 million had gone to port-related loan repayments, with $73 million more due in 2018. ChathamHouse.org. Public anger rose. In a cabinet meeting under fluorescent lights, the trade union leaders slammed the deal as neo-colonial trap. The government drafted a plan: reduce debt by leasing the port to its creditor, China. After months of closed-door negotiations, engineers in hard hats swapped blueprints. Officials in suits passed ledgers. A definitive agreement was reached July 26, 2017, a date that slipped almost unnoticed on global newswires, marked the transfer of operational control of Hambantota. Under the deal, Sri Lanka handed China Merchants Port, Port, a 99-year lease on the harbor in exchange for $1.12 billion applied against its debt. Reuters.com. In practical terms, this meant Beijing paid nearly $1 billion, and a local joint venture was formed. China would run the day-to-day business, while Sri Lanka kept nominal ownership. Trade unions protested loudly in Colombo's streets, fearing loss of control, and politicians insisted security remained with Sri Lankan authorities. Despite the drama, Hambantota stands as just one necklace bead, thousands of miles to the northwest. In the height of Europe's sovereign debt crisis, a similar transaction unfolded at the port of Piraeus. January 2016, the Greek finance minister Yanis Varoufakis presides over bailout talks in Brussels, and the Greek people watch bond yields spike on Bloomberg tickers. In Athens, the port authority needed cash to keep insolvency at bay. That spring, the Hellenic Republic Asset Development Fund signed a deal to privatize 67% of Piraeus Port Authority to COSCO Shipping, China's state-owned shipping conglomerate. Investmentpolicy.untad.org. For €1.5 billion, the Chinese firm would own 2 container terminals at Piraeus under a 35-year concession, eventually increasing its stake. By 2021, COSCO's share was 67%. Maritime-executive.com. Investmentpolicy.untad.org. We could almost feel the Greek spring sun on our faces as we imagine the scene. At Piraeus Dock, veteran dock workers gather over coffee and gossip. They see the familiar red and white cranes now painted orange and emblazoned with COSCO. A Chinese team oversees cargo manifest. Port CEOs in smart uniforms check stock tickers for container ship futures. One local newspaper headline: From financial crisis to fast trains, China at the helm of Piraeus. The port that once refused bids ended up fully in Chinese hands, again through investment disguised as market opportunity. What binds Sri Lanka and Greece? In both debt and investment. Under the Belt and Road Initiative, China often made low-bid loans to build infrastructure. When borrowers later struggled to repay, the solution was quietly brokered as a private deal rather than a diplomatic crisis. In Hambantota, the $976 million initial seaport investment in 2017 slashed Sri Lanka's loan burden. Reuters.com. In Piraeus, COSCO invested to modernize terminals and secure a foothold in the EU's transport network. Maritime-executive.com. Investmentpolicy.untad.org. In both cases, the result was the same: a pivotal port placed effectively under Chinese management without a formal military pact. The pattern repeats elsewhere. In Africa's Horn, China took over Djibouti's Doralek container terminal in 2018 after the government tore up an existing contract, again taking a long-term share. Stimson.org. In Pakistan, China already controls the Deepwater Gwadar port since 2013. en.wikipedia.org. Part of the China-Pakistan Economic Corridor, Gwadar even has a pipeline for Middle Eastern oil heading straight to western China. en.wikipedia.org. Each time a commercial contract or investment transforms into strategic leverage. For the people on the ground, these are transactions cloaked in finance, not warfare. A Sri Lankan sailor in a dinghy might greet the Chinese supercargo ships carrying wheat or machinery. A Greek crane operator might raise an eyebrow at the new Chinese managers reviewing shipping manifests. The paperwork all looks legitimate. A port concession here, a joint venture there, but the implications are enormous. The ink on deals in Hambantota and Piraeus is dry, but the true impact ripples outward. To grasp China's silent strategy, picture a global shipping map. At countless vital choke points sit Chinese-run terminals. Intelligence analysts note that Chinese firms hold an equity stake in at least one terminal in 96 foreign ports, nearly half along key sea lines of communication. AtlanticCouncil.org. More than half of those ports are within a day's sail of critical trade bottlenecks like the Suez, Panama, or Malacca Straits. AtlanticCouncil.org. In a crisis, control over these nodes isn't about firing guns. It's about flicking off switches. Imagine a future scenario. Tensions rise between China and, say, Taiwan. You're a Taiwanese electronics executive relying on a chip shipment arriving through a Red Sea canal. A Chinese-controlled port in Djibouti or Sri Lanka suddenly slows the offloading of that equipment. Back on Wall Street or the Tokyo Exchange, traders watch tech stocks wobble. China has not launched a warship, but its merchant ships halt deliveries. Financial markets crash as supply lines jerk. This is the essence of economic deterrence, the secret reason behind the port empire. Chinese leaders know that global supply chains are the new world's nervous system, and in network science, cutting off a single hub can paralyze the entire body. We have already glimpsed glimmers of this leverage. When politics fray, shipments can mysteriously stall. In late 2023, for instance, Western companies scrambling for components watched shipments delayed through Hambantota as local management enforced inspection protocols. Others note that Chinese outfits operating around the globe gather a treasure trove of trade data. Who ships what to which country and when? This intelligence alone is worth its weight in gold. By processing flow records from ports it controls, China can anticipate shortages or surpluses months in advance, almost like predictive. Lanka, chathamhouse.org. But the result is the same. Chinese interests gain a toehold in every harbor wall. For the watcher on deck, it's a chilling calculus. No one fired a shot, and yet entire industries could be held at ransom. In a world as tightly knit as ours, even a day's delay in semiconductor shipments can spell disaster for tech firms, and a slowdown in shipping can spike inflation. The United States, Europe, and others have only begun to grasp the magnitude. Recent reporting shows U.S. officials scrambling to counter this influence, exploring buying stakes in foreign ports or funding de-risked alternatives. Reuters.com, maritime-executive.com. But every new port project by China locks independence for decades. Ultimately, the secret reason China is chaining global ports under its flag, even as it claims to be just a shareholder, is simple: to build a quiet, economic form of empire. In this strategy, power rests in subtle vetoes, not overt threats. By controlling the gateways of world trade, China can exert immense pressure without a shot. Peaceful lever far more effective in today's wired economy than any gunboat. The calm surface of a harbor belies the leviathan of influence beneath. The most effective empires in history have been those whose might was invisible. China's global port network is the ultimate 21st century proof of this. Whether the world is prepared for such latent power is the big question. As ships continue to arrive and depart, one has to ask, if tomorrow's crisis unfolds at sea, will others know how to defend their supply line? Thanks for watching Atlas Money Chronicles, where every story reveals the truth behind money, power, and history.